The final accounting assumption number 4, is the accrual basis assumption. So over here, A4, accrual basis. What's that about? It basically says your net profit for the business is calculated by determining your revenues earned. That's the key word here, earned. That means they are recorded when they have been earned, not necessarily received. This bit's a little bit tricky, but it says that they can be measured in a faithful and verifiable manner. Don't worry so much about that bit. Just worry about this revenue earned. Minus your expenses incurred. Here's the key word, earned, incurred. Revenues are earned, expenses are incurred. That basically means that we're going to record expenses when they incurred, not necessarily paid. Basically what that means is they've been used or consumed. What are we talking about here? Well, under the accrual basis of accounting, revenues are recognized when they are earned. This sort of this fancy bit here, it says in the period in which the expected inflow of economic benefits can be measured. Basically, it just means, have you earned some revenue? Was there a document that can prove it? You've got some revenue. And expenses are recognized when they are incurred. Again, we have this complicated bit, but basically, did you incur or use something? Yes, you did. Is there a source document to back it up? Yes, there is. So that's been incurred. So under the accrual basis of accounting, all we need to remember is net profit equals revenues earned minus expenses incurred. So I think the easiest way to understand this is to look at the opposite and go, well, once upon a time, basically all the transactions in the world were cash, all right? That doesn't happen anymore. But once upon a time, under the cash basis of accounting, you could calculate your net profit very easily. It was your revenues received minus your expenses paid. That is different to the accrual basis, where we say we've got revenues earned, expenses incurred. What's different here? Net profit's the same. We've got the word revenue, got the word revenue, got the word expense, got the word expense. What's different is here it says revenues received versus revenues earned. Expenses paid, expenses incurred. How are they different? Well, this one's wrong. We don't do this anymore. Maybe if you're a very, very, very small business and everything's cash, but nearly every business in the world today, we have to do this one. Why? Well, let's have a look at an example. This doesn't really work when we say revenues are received when we receive cash. It does for some things, but other times it just won't work. We'll have a look at an example. Why? And this won't work either. We only recognize an expense when we pay cash for it. Sometimes, but overall, that's just not going to be reliable enough. So what we're going to do, let's have a look at an example here. Why is this not going to work? Let's take this guy. John is a plumber, and today he unblocks a drain for a client and charges them $300, but the client is allowed to pay within the next 30 days. He hasn't got the money yet. We call this a credit sale, by the way. But yeah, he hasn't got the money. He's earned the revenue, but hasn't got the money. So the problem here is we're only going to recognize revenues when received. He has not received anything. So under this system, revenue is zero. All right, what about that? To actually unblock the drain, he had to purchase $50 of new tools, but the plumbing supplies business gives him 30 days to pay. He hasn't paid for his tools yet to do this job. That's called a credit purchase, which we'll deal with in a later chapter. However, under this system, we're only looking at expenses when they're paid. He hasn't paid for these tools, so that's zero. So in the cash basis system, we've got net profit equals 0 minus 0, that's 0. So basically under this system, nothing's happened. And that is stupid. That's not what's happened. What's happened is he's earned $300 and he's used up $50 of tools. So this is dumb. This is silly. So what we're going to do is the accrual basis instead. And we're going to recognize revenue when you earn it. So by selling a good or providing a service, and we're going to minus that with your expenses. You incur an expense when you consume it or use it up. So that's going to be the correct approach. Let's have a look. Why is this more accurate? Well, let's take the exact same figures. John's a plumber, does a job today, hasn't got the money though. Still, he's earned it. So if he's earned it, that's $300 of revenue. Let's look at the tools he had to consume or use. Well, yeah, he hasn't paid for them, but he has used them. We use the word incurred there. So he has incurred that. So that now makes sense because he earned $300. He incurred $50 of expenses, so his net profit is $250. And that's the accrual system. So that's the key words we want to remember from this. Revenues earned minus expenses incurred, and we're going to get the most accurate profit using this system.